Good morning, everybody. This is Brian Dewars with Uncommon Wealth Partners, bringing you your market update and Bitcoin briefing. It is the middle of October, and it's starting to look like fall outside. The S&P 500 is up 18.85 year to date. NASDAQ up 21.91. Dow Jones up 15.33. Gold up 16.08. And Bitcoin, as of close today, up 124.80. Let's jump into the charts. Always do. This is the S&P 500 on the daily. You kind of see this long kind of up, down, up, down, up, down horizontal trading range we've been in. We're trying to break out of. Just wanted to show you that. And really, you know, the Dow and the S&P and the NASDAQ have traded in this range for about 18 months. This is February 2018 right here at this kind of peak. And then this is kind of September 18 into Christmas here. And then we've kind of pulled back out, pulled back down, up, down, trying to go back up. So been choppy, and we haven't really gone anywhere. You know, at the peak here, this was, I think, like 285. February 2018 is like 285 on the SPY, which tracks the S&P 500. And as like today, we're at 295. So very minimal over an 18-month period. So looking for more traction. Actually, it'd be like 20 months, but I digress. Let's get into the weekly chart. You kind of zoom out a little bit, still see that trading range. And you see right here that we still have kind of price on top of the moving averages. That looks good. Some green dots, and the market is squeezing down here, kind of meaning pressure is building. So we're going to see and watch that and see which way that it breaks. But looks good, looks bullish. And the QQQ, I wanted to show you the NASDAQ looks kind of similar to what we just talked about. A little less of a peak here in February, you know, but looks very similar as well, squeezing down here. Prices on top of the moving averages here, and that looks strong. So the data is suggesting that it will continue to the upside, but we just need to keep watching. Use the data points. It's not a prediction, just looking at the probabilities of the charts and the data that the market gives us. In that, let's go to gold. You see gold is kind of, this is like a bowl formation, and just long. I mean, this is really long. This is a 7-year bowl. Gold has been in the doldrums, and then it kind of turned up. And you can kind of see since really like 2015, it's up significantly. And yeah, looking good, looking strong. We got teal down here, 6 green dots. Looks even healthier than the S&P 500 in terms of these metrics. But yeah, looks good. Should continue to go higher as it appears on the chart. And again, it's not a prediction, but probability that we should be open to higher prices based on what the market's given us. This is a Bitcoin on a daily, so pretty, you know, a lot of candles. You can kind of see this is almost the exact opposite. You know, 6 red dots, no teal bars, prices below the moving averages. So looking, you know, if you look at this right here, this kind of sled action, this falling off a cliff, looks very similar to down here. Look how long we had to trade sideways before another uptrend continued. So could be in this trading range for a while, it appears, with potential for lower prices. So that's where we're at. Now I want to cover the news, because that is the more fun part. Saw this chart, was I thought it was really good. Talks about hotel occupancy rates and kind of comparing trends versus 2009 occupancy rates. You kind of see here on the black line, and then median 2000 to 2018. So kind of like 18-year average type occupancy rates. And then the dotted line here on top, 2018, super high occupancy rates. And then 2019 tracking 2018 almost verbatim. And, you know, this dotted line, are we going to see, you know, lower prices or lower occupancy rates with hotels? Well, hotels are kind of like a leading indicator, because, you know, when people stop staying in hotels, it's an indicator of how healthy the consumer is and what they're doing with their money. So that's why we're looking at it. Kind of interesting. Now onto this. Saw this tweet, thought it was super good. Germany is looking to start passing negative rates to their retail banking clients. I've talked at you know, several of the last videos about negative interest rates and that trend in Europe and other parts of the world, and that it's real, and that we could be facing that here in the States in several years. Germany is considered like the top financial country in Europe. They own the second most gold of any country in the world, second to the United States. So you got a lot of manufacturers over there, a lot of car manufacturers, Mercedes, BMW, bunch of manufacturing firms over there. And yeah, they're passing negative interest rates to their clients. So let's say you had 100 grand in the bank and they're charging you a negative 1%. So you can do the math. Obviously, if they're paying you 1%, they're going to pay you $1,000 a year. If they're charging you 1%, they're going to be charging you $1,000 a year. So they're going to be debiting your checking account to just hold that money in cash. And so the stimulation and the debt and the printing of the money that the European government has done, Britain, United States, China, South America, all these different countries is just, it's having a smaller and smaller impact. We call in the economics world diminishing margin of return, meaning for every dollar of new stimulus, it's having a weaker and weaker response. And so anyways, yeah, we're seeing negative interest rates at the banks in Europe. And so I wanted to also show this gold sector. That's like companies that mine gold, so gold stocks. And this is October 1st to 2018, so just over a year. Gold is up 27%. I showed you that on the chart previous. And the Dow over the last 12 months, kind of like I talked about the S&P, up barely at all because it was in that huge decline last year before Christmas. So gold performing very well. As interest rates go lower, gold should do better. Gold is a hedge to inflation, it's a hedge to currency risk, and it's a hedge to debt. This is another great set of charts. Sorry, there's a lot going on the slide, but I'm going to explain it. U.S. Federal Reserve total assets. This is like the balance sheet of the Federal Reserve. And you see here in 2008, 151% expansion of the Fed balance sheet. And you see 2011 to 2014, like on a compounded basis, was like over another 75%, which is like nearly almost double. They're doubling their balance sheet in that time period. And then they've really not decreased the balance sheet really significantly at all over the last several years. And the Fed recently just came out and said they're going to stop contracting the balance sheet and move it back up. So from 2002 to 2019, the balance sheet is going up 439%, dramatic. Over the same period, S&P roughly up about 180 to 200%, depending on which time of which day of the year you pick to price the S&P 500. But again, about 50 cents on the dollar compared to what the Fed has done by expanding their balance sheet. The stock market is heavily correlated to the money supply, and the Federal Reserve balance sheet is a reflection of the money supply in effect and all the different stuff that they're doing. Chart up here on top, federal government current expenditures, interest payments. So this is the interest on our debt. You look down here just below, we've got almost 23 trillion in U.S. national debt. That's like current on the books. That's not unfunded liabilities and all that. That's like what's already been spent. And so you can kind of see that the interest expense on the federal debt is going up. And this data is from the Federal Reserve St. Louis branch. They do all the data for the Fed. So this is from the horse's mouth. And so, yeah, 600 billion annually of interest right now. And you see that trend going higher. And the debt is getting out of control because you can't really see it right here, but it says U.S. federal budget deficit official. We're going over $1 trillion to $1.5 trillion. We're spending more than we are taking in annually within the federal government. So the federal debt is exploding at a rapid pace. I think by like 2025, you could easily see the national debt approaching like 35 to 40 trillion. Trillion with a T. I mean, just let that sink in how much money that is. It's crazy. And so the interest expense is going to continue to go up. And that's why I don't think the Fed can raise interest rates meaningfully on themselves, because just think if 20 trillion at 5% interest, if that was the interest rate effectively that they were paying, which they're paying way less than that, by the way. If you think about it, like 600 billion on 23 trillion, I think is a little less than 5%. But, just 5% at 20 trillion would be $1 trillion in interest expense. So nearly almost double from where we're at now if the interest rates were at 5%, which is crazy to think about. So that's just something we're watching, and why we're talking about Bitcoin, why we're talking about gold, why we're talking about the stock market, because all this stuff is related. This is an article from fortune.com talking about Visa investing quite a bit into a cryptocurrency startup called Anchorage. This is not a promotion of Anchorage. I don't own Anchorage. I'm just saying Visa is one of the largest fintech credit card companies in the world is investing in cryptocurrency at a staggering rate. This Bart Stevens is saying that this Anchorage has one of the most compelling products they've ever seen. I honestly haven't looked at it. What I'm looking at is the fact that Visa, major financial player globally, they're advertising the Olympics, taken everywhere, probably building North Korea. They're investing heavily into the blockchain. So that's a trend we're watching. And I thought this was good. We're just going to continue to talk about inflation, especially as retirees age and people get older, things get more expensive. And this is saying premiums and deductibles rise faster than workers' wages. In blue at the bottom, we have overall inflation, which is reported by the federal government. It's about 2% annually. This is a 10-year chart, which, if you've gone to the grocery store lately and you think back 10 years, I don't know if it's only 20%. I'll leave that to you. But from there, we have workers' earnings only up 26% over a 10-year period. And then you have 54% growth in family health insurance premiums, and then 162% growth in deductibles. That's like what you got to pay out of pocket before the insurance kicks in. So inflation is real. And as they print more and more of our money and lower interest rates, it forces money into other asset classes. And that's, again, why we continue to talk on the podcast about 7 streams of residual income and owning assets that produce cash flow. That is the only way to truly hedge against inflation. And owning real estate, owning the stock market, owning businesses that produce cash flow. Gold is a hedge to inflation as well over a long period of time. So all these things are acting in concert with each other, and that's why we're covering it. So if you have other questions, please feel free to reach out to us, uncommonwealth.com. You can schedule a free 15-minute call, and we'd always love to talk to you. And then, hope you have a wonderful October. Happy Halloween, and we'll talk to you soon. Thanks, everybody. Bye.
The material in this video has no regard to the specific investment objectives, financial situations, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell a security or any other related financial instruments. Nor should any of the content be taken as investment advice. Any of the opinions expressed in this video are subject to change without notice, and Uncommon Wealth Partners LLC is not under any obligation to update or keep current the information contained herein. Uncommon Wealth Partners LLC and its respected officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. Uncommon Wealth Partners does not accept any liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.